Last year, we extended our operating hours for our clearinghouse. We moved the time up from 4 a.m. to 1:30 a.m. And that was sort of phase one of a two-phased program, where next year, of course, we are going to move towards a 24/5 cycle at DTCC, and really reacting and projecting where the market is going, and in developing our technology and evolving our products and services in a way in which is meaningful for our clients. This is very much commensurate. So it won't materially impact cost, because of course that was had already been projected for in terms of the technology investments that we wanted to make. And we think largely the support structure and other maybe extenuating costs that would ensue in a change like this. We think our global footprint, our existing organizational structure already fits nicely into being able to facilitate this type of change for the industry.
What is DTCC's opinion on extended trading hours?
DTCC is supportive of the move by the SIP to extend the trading hours and the operating hours beyond the current hours that are operating in our industry. And in a lot of ways, this is a good move for the industry and our underlying clients, because it opens up access through different venues to markets beyond largely 8 p.m. that exists today. And so that extending the trading hours and in a lot of ways establishing a standard operating trading day in the United States, that ends at 8 p.m., I think is a real positive for the industry. And in a lot of ways, it's the standard trading day starts to address a lot of the issues that could surface from different venues taking different approaches to those operating hours, and things like corporate action events not being processed consistently across different venues. And so we're supportive of the extending trading hours. We at DTCC are also extending our clearing hours, and so extending the hours of our NSCC, our clearinghouse, to be able to address the proposal, and in many ways consistent with the proposal. And so we'll be operating on a 24/5 basis going forward, and that is in Q2 of next year. We'll extend our operating hours from 8 p.m. Sunday until 8 p.m. on Friday, and that will be a continuous 24/5 cycle where we will be open. We understand from the SIP proposal, and it's sort of being discussed still in the industry, that the exchanges may have an hour downtime. Now, so it hasn't necessarily been cemented as to when that is, but it likely will be between the hours of 8 p.m. and 9 p.m., where the exchanges in the U.S. will be down for maintenance and other things. But largely the ATSs will still operate on that 24/5 cycle. And so, of course, that the clearinghouse being open 24/5 allows sort of continuous clearing, irrespective of the venue that our clients choose to operate on. And so a lot of discussion that's happened with SIFMA and other market constituents, including the exchanges and ATSs that operate today or have intentions to in the future, around addressing any of the extenuating issues that still exist that need to be addressed. But certainly direction of travel is very positive, I think.
What is the next step to get ready for 24/5 trading?
There's work that's already happening that's largely organized by SIFMA with sort of the major constituency groups in the industry, exchanges and ATSs, and they're working through some of the points that still need to be addressed. And so, one of the things that, of course, was an immediate sticking point was just creating a standard view of the trading day in the U.S. market. And again, that has a knock-on impact to things like corporate actions or asset servicing processing. And so establishing that consistent view, now, each of the venues that clients may choose to execute upon, there's a consistent view of the operating hours for that venue. And of course, the standard operating hours will have a knock-on impact to these ancillary processes like asset servicing, as I mentioned. Volatility limits, sort of volatility up and down limit, sort of the standards that are operating during the normal convention of a trading day. Those also need to be addressed in the post 8 p.m. Cycle as well. And those are kind of points that are being addressed through the work with SIFMA as well. So there's There's still a few outstanding points that need to be addressed with the industry, with the major venues, with this work that SIFMA is doing. But I think certainly all are on a positive trajectory. All are on a path to be sorted, call it within the next year, when we as the clearinghouse expect to be live, as I said, sort of in called the June time period next year.
What is the update for Treasury clearing?
In Treasury clearing, 24X is certainly a large point of focus for our firm, but Treasury clearing has equally been a point of focus for our firm for many years, starting with the draft rule and the final rule that ultimately came to pass in December of 2023. We actually earlier this year, in late March, went live with our compliance with the new Treasury clearing mandate, because of course there were really three components to the Treasury clearing rule in terms of those dates. You mentioned two of them in terms of the cash deadline and the repo deadline, but there was equally the clearinghouse needed to be compliant as well. And of course, we have done that, sort of in the March time period. So I think what work is still left to come. So we are open for business. We are seeing a tremendous amount of activity, given that that not only that we're live, but you sort of had certainly many access models in place that would service much of the industry even before we went live with the compliance with the Treasury clearing mandate in late March. If you think about the draft rule coming out in 2022, our volumes were at roughly 4.5 trillion, where we peaked at the volatility we saw in sort of early April around 11.4 trillion. So you think about more than double the amount of activity we've seen over the last couple years has come into clearing, and that's well before a mandate. That's because clients are seeing commercial benefit that they can derive by moving their activity into clearing. So I think of that as we're going to continue to see an uptick in volume over the course of the next 18 months as clients not only prepare for the mandate, but equally as the market continues to see value in putting activity into clearing. Now, other aspects of the Treasury clearing rule that still need to be addressed. Well, the mandate itself was extended by 1 year to address a few outstanding, largely to address kind of a few, or to get clarity on a few outstanding scoping points, such as the activity that happens outside of the United States in branches or on non-U.S. platforms, the mixed QSIP, so-called mixed QSIP issue in terms of whether that is a in-scope activity for the Treasury clearing mandate. So there's a few scoping kind of points that need to be addressed, and that's of course the industry working hand in glove with the SEC to refine and to get levels of clarity on the points that are outstanding. I think equally the point I'd mention is we hear a lot about the advent of Dunaway, and that development still needs to sort of mature, particularly for repo. Now, if you think about for the cash market, we as FICC already offer a Dunaway service for cash treasuries, and actually we've seen a pretty significant uptick in the last year as well in that activity, where we were sort of roughly around 90 billion a day in activity in the Dunaway cash market. Again, in that sort of April period, we peaked to over 300 billion. And so again, more activity coming into clearing. We think because really for commercial reasons that's taking place. But equally, now what needs to happen for the repo market, we're working hand in glove with clients, with other industry constituents around workflow, documentation, the other aspects that are really going to mature the Dunaway repo market over the course of the next year. And those I think are the key components that still need to be put in place prior to the mandate. Now, on a discretionary basis, not necessarily directly tied to the mandate, we're continually thinking about how we make our offering more commercial and how we service the needs of all of our clients in the industry, not just those that are ultimately using the advent of clearing today. And so there'll be new access models that we will release over the course of the next 3 to 4 months that we think that will have a material impact to many different client segments. So that's one component. And I think the second thing I would probably mention is, we're conscious that we today do not have a default fund. And so that's an important piece in terms of feedback we've received from clients. That's an investment that we are intending to make in 2026 prior to the mandate going live. And so those are two pieces that, from a commercial perspective, we think that will have a material impact on our offering and our clients in general.
What lessons were learned during the movement to T+1?
We helped move the equities markets in the United States last year to T+1, I think in many people's eyes, rather successfully. And that was a joint effort between all parties in the industry to ultimately make that happen. Not only was, like it has been in a prior regime, a move from 5 to T+3 from T+3 to T+2, there was, of course, the move itself to a different settlement cycle. But I think what was somewhat unique in the U.S. was there was also a condition as part of the final rule, which required market constituents to allocate, confirm, and affirm their activity on trade date. And that was not only a rule change that clients needed to be compliant with. In some cases, it was actually a new process that clients, particularly outside of the United States, would need to undertake that in a prior settlement regime they did not. And actually, it's sort of the concept of affirmation doesn't necessarily exist outside of the United States. And so there was a lot of education that took place. And so that's a good starting point. And that's one of the kind of baseline levels of success is the amount of education that was required to make the rules, for everyone to understand the rule and then ultimately, figure out the changes that they need to take place and implement within their own firm to ultimately drive towards the change to T+1. And, we had put together a public website. We had, people on the ground meeting with different clients, attending different conferences. And so there was really sort of a groundswell of interaction with many parts of the industry that really helped with that baseline level of education. I think that's number one. I think two was we saw a large portion of the industry that interacts with the U.S. equities markets implement automation. Some of them were already using tools and capabilities that would allow for automation. Some of the automation was specific to their own firm. Some of it was using third-party tools like those that are offered by DTCC. But really investing in automation was a big key to success as part of this transition. And then the third thing I'd probably say is testing. So we had multiple testing windows, which allowed clients not only the flexibility to be able to test the conditionality of that particular test window, but equally to write their own script that would allow them to participate in n number of testing windows that they thought was appropriate for their business mix. And so it's I think a diverse set of testing scenarios, but also the flexibility to allow clients to script that for themselves. I think that's a key foundational component to success. And so we have those and other kind of aspects of what I'd call lessons learned from a successful transition to T+1 in the United States has really been a key input to much of the work that's happening in the UK and the EU around their transition in 2027.
What can firms expect with a move to T+1?
We as a firm continually talk about the fact that we returned $3 to $4 billion in capital that would otherwise have gone to the clearing fund in the form of posting margin that no longer is required as a function of eliminating a full day of activity from the clearinghouse. And so that's not only important during what I'll call peacetime, right? The kind of normal run rate activity that we see in the market. That's equally important during periods of volatility. And so again, I'll point to the sort of early April volatility that we saw earlier this year. The amount of clearing fund that we collected was less than peak periods in a T+2 settlement environment, despite the fact that in early April, we cleared the largest amount of activity as a firm that we've ever cleared in the past. The clearinghouse, our equities clearinghouse, cleared 5.5 trillion of activity on April 9th, but the amount of clearing fund, the amount of margin that we collected was less than peak periods, which are roughly over 4 trillion of activity in a T+2 environment. So again, not only does it help from a sort of a normal run rate peacetime period and the amount of clearing fund that's required for clients and reducing the settlement cycle, it's also critically important to help the market from a stability and resiliency perspective during periods of volatility as well.
What are you most excited about over the coming year?
24/5 or 24/7, ultimately, potentially the Treasury clearing there's a lot of market, the capital and liquidity optimization opportunities, cross margining, how do we do more with others and as an industry? There's a lot of market structure change that is happening in the industry right now. And much of what we talked about is really in the TradFi market, sort of the traditional financial services markets where there's a tremendous amount of change that's happening, either driven by regulatory change or driven by a number of different factors, clients searching for yield, banks searching for opportunities for capital and liquidity benefit. And we're here to help foster that change for the industry. The area that we haven't necessarily talked about, which I think has as much excitement from my standpoint, is where does the digital assets ecosystem go? There's a tremendous amount of interest and effort being put towards the development of the digital assets ecosystem in the future. And we're at the center of many of those, if not all of those conversations that are happening as to, in my mind, really what that is we're charting a path to what the market infrastructure and the market ecosystem, sort of the market structure looks like in the future with the advent of digital assets, which has me incredibly excited as sort of inherently a bit of a market structure person. But equally, the role that DTCC has played for 50 years in public markets, how we play as much of, if not more, of a significant role as the digital assets ecosystem continues to develop in the future.